Jonathan, the true conglomerate, the completely illogical grab bag of corporate assets, reached its peak in popularity in the 1960s, had almost disappeared by the 1990s, and the ones that do persist are associated with scandal and activist investors and all sorts of trouble. Yet, a true conglomerate is entering the FTSE 100. Surely, Lex is going to rail and stomp against this development.
Well, that is, of course, the obvious reaction. The company you're talking about is called DCC. It is worth almost £5 billion in terms of market cap, so it is probably the biggest company that most people have never heard of. And it is a conglomerate. It has four divisions. I just came off the phone with the CEO. He freely admits there is absolutely no synergy operationally between any of them. And that if they are sort of contra-cyclical in any way, that is by accident.
And what do they do? What are the various?
So the biggest division by sales, about 3/4 of sales, is energy, which basically distributes sort of butane gas and LPG and things like that to industrial and commercial and domestic users. And this is a business that big oil companies cannot wait to get out of because it's downstream and it is miserably low margin. I mean, this business makes margins of about 1.5% at the operating.
Go on. What are the other bits?
The other bits are healthcare, so they do contract manufacturing and, again, supply and distribution. There is a technology distribution business. Did you know that all Xbox 360s in the UK are distributed by this company? I bet you did not. And finally, they have an environmental business as well, which basically carts rubbish away from commercial and industrial premises.
So a lot of trucks and warehouses, probably low margins across all the businesses. I guess the question is, should it be broken up? This is the question Lex always asks about conglomerates. And the other question is it a good business, just purely on its financial results?
Well, when you look at it, you look at all these different business units, the first thing that springs to mind is that it's a sort of brutally hard, labour-intensive, sort of lots of moving parts, low-margin way to make a living. And yet this is a company that over 10 years has delivered a total return of over 650%. The index it's entering, the FTSE 100, has delivered 80% by way of comparison. So clearly, they are doing something right. That's something I think has got a lot to do with cash management. They are very focused on cash flow, returns on capital.
Yeah, in a business like this, you have to watch your working capital very carefully.
Nobody owes this company money for long. Their debtor days are consistently less than 30, so they're very good at that. The other thing they're very good at is acquisitions. So they have this kind of template. They go and do one little bolt-on deal after another. And to your point about divestments, they are not actually averse to divesting things. They have sold divisions in the past. They may yet do so again.
So it sounds like Lex is going to withhold judgment on DCC despite our congenital aversion to...
I think the summary has to be that we don't like conglomerates very much, that we think investors should do diversification themselves, except when they work. And this one does seem to work.
Thanks, Jonathan.